Hello friends, so today we will continue the topic with tools and techniques of technical analysis. In order to predict the price behavior, various tools and techniques are used by technical analysts. And these tools and techniques are broadly categorized into three parts. First, theories, charts, and market indicators. First of all, we will start with theories. So three theories are given by technical analysts, namely Dow theory, Elliott wave theory, and efficient market theory. Dow theory. Dow theory is one of the oldest and most famous theory. So this theory was given by Charles Dow in year 1900 and which founded the Dow Jones Company. That's why this theory is popularly known as Dow theory. So this theory believes that the behavior of stock is 90% psychological and 10% logical, which means that the trend in market is more due to change in attitude and the performance of the investors. The mood of investor determine the way in which the price moves. The basic idea behind the Dow theory is that market price action reflects all the information. The theory also describes the direction of trend in the market and does not attempt to forecast the future movement. There are 6 basic principles of Dow theory, starting from markets discount everything, 3 trends in the market, 3 phases in the market, 2 types of the market, average must confirm each other, volume must support the trend. Market discounts everything. So the first basic premise of Dow theory suggests that all the information, past, current, or even future, is discounted in the markets and is reflected in the prices of stocks and indexes. That the information includes everything from the emotions of investors to inflation, along with the pending earnings announcements to be made by the companies after the close. Based on this tenet, the only information excluded is that which is unknowable, such as massive earthquake or floods, etc. But even then, the risks of such an event are priced into the market. Charles Dow has considered that there are 3 movements in the market, namely daily fluctuations. Daily fluctuation is also known as minor movement, which means day-to-day movement. Because of short durations and variations, they have little analytical value. Second is secondary movement. It is also known as short swing movements. They act as a restraining force on primary movement and it normally ranges from 2 weeks to a month or more. And the third main are primary trends. These primary trends are also known as lengthy movement and it covers a period of at least 4 years. These trends carries the entire market up or down and the bullish and bearish trend can also be seen during this period. According to Dow theory, there are 3 phases in the market: accumulation, participation, and distribution. Accumulation is the first phase of primary bull market, where informed investors make buying decisions and there is no much noise in the market. People accumulate stocks on declines and hold it for gaining in coming times. The market may be down, but smart people think is it and no more decline in the markets. Second, participation. Participation is the phase when market starts showing signs of reversal and the people join in and start confidently buying stocks, taking the market to the rise at higher levels. And this works in the favor of the market. In short, buying interests is at its peak. Third, distribution. Once the market are heated up with excess buying, we see smart investors booking profits followed by other people who accumulated in the second stage of participation. Suddenly, lot of profit booking happens and the markets are back in the selling spree. And hence, the market falls like a pack of cards, which is nothing but the distribution stage. Types of market is also discussed in Dow theory. There are two types of market. First is bull market and second is bear market. A bull market is a market that is on the rise and where the economy is sound. And a bear market is a market exists in an economy that is receding, where the stocks are declining in value. The chart shown in this slide shows both the trend. The portion which is green in color shows that the stock price in market is going up, which means that there is bullish trend, and the portion which is red in color shows that stock price in the market is going down. It means that there is bearish trend. Dow theory is based on the assertion that stock prices tend to move together. On the basis of this, it employs two Dow Jones averages, which are Dow Jones Industrial Average and Dow Jones Transportation Average. Dow Jones Industrial Average is an index that tracks 30 large publicly owned blue chip companies trading on New York Stock Exchange and National Association of Security Dealers Automated Quotations, that is NASDAQ. The index was created by Charles Dow in 1896. Dow Jones Transportation Average is a price-weighted average of 20 transportation stocks traded in the US. In addition to railroads, the index now includes airlines, trucking, marine transportation, delivery services, and logistics companies. The Dow Jones Transportation Average is the oldest US stock index, first compiled in year 1884. Averages must confirm each other. Dow was of the view that two averages must confirm each other. So, if the Dow Industrial is moving higher and the rail average is not performing, this means there is something fishy in the markets and the bullish run cannot be confirmed, and vice versa. So averages must confirm each other. If the Dow Industrial is going up, even the rail average must follow the suit, and vice versa. There are few criticisms in Dow theory. First is interpretation of known data. It explains that this theory is not a theory but interpretation of known data. Means that the theory should be able to explain why a phenomena occurs. No attempt was made by the Dow or any other follower to explain why the two averages should be able to forecast future stock prices. Not used for forecast. As we have already discussed that it is not acceptable in any kind of forecasting. There was considerable lag between the actual and the indicated points by the forecast. Another criticism is that it has poor predictive power. Rosenberg has stated that prediction given by Dow theory about the bullish and bearish trend in the past was incorrect. So, poor prediction is just like flipping a coin by the investor. This is all about the Dow theory. So, thank you very much and keep studying.